With the current interest rates as low as they are, we are seeing a huge demand to buy homes. But we don't have a huge supply, and so this has caused the house prices to soar in recent times. And the concern now is that if these house prices just keep moving up and up, is this sustainable? Or will the housing market crash like it did in 2008? So in this video, we'll be sharing our thoughts on this looming real estate bubble. We'll be looking at what did happen leading up to the 2008 real estate crash. We'll also be looking at the UK's mortgage payment holiday programme, and most importantly, what all of this means for you. So before we dive right in, let me ask you to dive your finger straight into the like button and let's get started. Hey, what's up people? Welcome back to our channel, Rao Finance UK. So let us get straight into it. New homes are being sold at record highs. We have homes literally going into bidding wars because they have multiple offers coming in, which is just pushing these home values up higher and higher and higher. And with these prices being pushed up as much as they are, there are talks of a looming housing market crash. And so if we want to understand what is going on in the housing market today, we need to go back to what really happened leading up to the 2008 real estate crash. Now, although there wasn't a one single cause to the 2008 housing market crash, what we do know is that in the years leading up to 2008, if you wanted a mortgage, all you had to do was really just go into the bank and simply just tell them. In the early 2000s, even if you didn't have an income and you didn't have a job and you didn't have any assets, you could still qualify for a huge mortgage because banks had so much confidence in real estate, they literally thought real estate could never drop in value. So in the years leading up to 2008, lending became very relaxed and anyone who wanted a mortgage could go and get one, and this led many people to being over leveraged. Many people were now buying a home even though they couldn't really afford one. Now alongside this, we also had banks offering various marketing strategies just to help you get the biggest mortgage loan possible, because this meant more profits for them in commissions, which kept their investors happy, and banks were also enticing people by giving them a low initial rate. So banks started giving people these variable interest rate mortgages where the initial monthly payments were low and then this would later increase. And this was literally just a way to get people to sign up because people were just paying attention to these low initial monthly payments. Now, another main driving factor was the competition between banks. When investors at banks saw that a particular bank is issuing multiple mortgages and earning returns, this then had more and more banks following suit as they all wanted returns on their investments. Banks were now making huge profits and the stocks were soaring, and now you could get that home that you always wanted and have low monthly payments. And if the interest rates did go up, you could just refinance. Now, these lending practices went on for years. Some homeowners were concerned that if the interest rates did go up, then they wouldn't be able to afford their monthly payments anymore. But the banks would just tell them, real estate prices always go up in value. So if your monthly payment goes up, you can just refinance to a lower interest rate mortgage. But that is not what ended up happening. In 2005 and 2006, we reached a critical turning point. By the time these low initial rates had expired, many homeowners just couldn't afford the new higher monthlies, but they also couldn't remortgage to move to another lower interest rate mortgage like they thought initially they could. Why? Well, that's because home prices had dropped a little, something no one had accounted for. And so now many homeowners were stuck because, they couldn't sell their home because they wouldn't get enough money to pay off their mortgage. They also couldn't refinance because they didn't have enough equity in the home and they didn't have enough money coming in from their job to make their monthly payments. A bit of a sticky situation. Many people now were only left with the option to default, as a lot of homeowners ended up owing more than what their home was worth. And these circumstances then created a massive wave of foreclosures, and this then caused the real estate price to drop even further and eventually come crashing down. Although the crash did happen in 2008, it wasn't actually until 2012 that the market bottomed out. After 2012 is when the real estate prices finally started to go back up again. So how does this compare with today? Well, there are many similarities, but also some key differences. So firstly, for the last 7 to 8 years, mortgage restrictions have started to relax yet again. And then in 2019, interest rates were cut. Then in 2020 came this pandemic and the Bank of England cut interest rates yet again. And this was in order to get people to spend and stimulate the economy. The economy runs on people spending, and so because the UK economy is in a recession, the Bank of England lowered the interest rates as a way to make money cheaper to borrow, which then encourages people to spend more. But because the Bank of England has cut interest rates to pretty much all-time lows, near 0%, you can save a substantial amount of money by refinancing your mortgage to a lower interest rate mortgage. Now, don't take out more money than you need, because this is an opportunity to put more money in your pocket, not your bank's pocket. And something to bear in mind, with the interest rate so low, some lenders are now charging higher arrangement fees as a way to still make their profits. So make sure you're getting the best deal possible when refinancing your home by considering not only the interest rate, but also the arrangement fee. Lower interest rates have also allowed people to buy much more expensive homes to what they would have done otherwise. Let's take this as an example. Let's say you could afford a monthly of £1,000. So if you take a 25-year mortgage at 5% interest, then you can afford to buy a £170,000 home. Now let's say you have the exact same scenario, but now let's say the interest rates are 2.5%. With the same £1,000 monthly, now instead of a £170,000 home, you can actually afford a £225,000 home. Same monthly, but more than 30% increase in leverage. And this has caused house prices to shoot up as people are able to afford more. You see, people want the best home possible, but they're always constrained to their monthly payments rather than the house price itself. And so now, with people taking out mortgages for more expensive properties, this has led the housing debt to spike. And also, we now have new buyers who feel pressured to buy homes before these prices go up so much that they become unaffordable. And more buyers means more demand, and so properties sell for more. I mean, if we take a look at the UK National Home Price Index, we can see that even when adjusted for inflation, house prices are already higher than what they were in the 2008 housing bubble crash. But now, also in 2020, as these interest rates were cut and home ownership boomed and the prices shot up, so did missed mortgage payments. And that's where we have a critical difference between now and 2008, because now the government is offering a mortgage payment break for up to 6 months. And this allows people to pause their mortgage payments, meaning they cannot be foreclosed upon. However, this program does not mean that these mortgage payments will just simply go away. No, people will still have to make every single mortgage payment and interest payment that they didn't pay in addition to the rest of their mortgage. So if you're a homeowner who is facing financial hardship and you cannot pay your mortgage, this is not like 2008 where you had to default on your mortgage and your foreclosure process started right away because you couldn't refinance or sell. Now, however, the prices are shooting up, and so people have both options: sell or refinance, and they have this third option to use their mortgage payment break. Put it this way, in 2020 we have more mortgage delinquencies than ever before, but we have less foreclosures happening in 2020, and this is due to the mortgage payment break. I just want to say, if you are finding value out of this video, then I'd really appreciate it if you could hit that thumbs up button, as it helps get our content in front of more people just like yourself. So now in 2020, if you don't have the money to pay a mortgage, then we have this government created mortgage payment break, which allows people to put their mortgages on hold, but this is scheduled to end in 2021. And so if after this program ends, we then see a lot of foreclosures happen, then we will have a large supply of homes on the market, which could potentially cause the house price to drop. In the housing crash in 2008, it wasn't actually until 2012 that these house prices bottomed out. And so if house prices do crash in 2021, then it is likely we're not going to see the full effects of this crash until at least 2022. So as a comparison, in 2008, you had the mortgage monthly payments going up after the low initial rates, and you had home prices going down. And there was no mortgage payment break back then, which meant this was essentially the perfect recipe for a housing market crash. But now in 2020, with the Bank of England having reduced the interest rates so much, and we have the home prices going up, and we have the mortgage payment breaks, now people have 3 options. They can either remortgage their home to a lower mortgage monthly payment because the interest rates are so low, or they can make use of these rising home prices. They can sell their home, downsize, pocket some cash to help with their financial situation, or they can put their mortgage on hold. So you can see that in 2008, people were stuck. There was no real option. They had to default, and the bank would foreclose upon them. But in 2020, people have these 3 options. Overall, there's just so many different scenarios that could potentially pan out, but there are a few numbers that we should be paying attention to. The first is the mortgage interest rates, second is the home prices, third is the unemployment number, and lastly the forbearance number. Whether the housing market crashes or not will likely depend on these 4 factors, and so if we pay attention to these 4 factors over the course of the next 12 months, it may help us to gauge how the housing market may respond. If the economy recovers and unemployment reduces, then foreclosures are unlikely to happen as people will be able to make their mortgage payments. But if the economy does not recover and unemployment increases, then foreclosures are likely to happen as people will not be able to make their mortgage payments. We don't know how many people are using this mortgage payment holiday break, but they do have the means to pay their mortgage. And also, we have a lot of people out of jobs, but we don't know how many of these people have just been temporarily furloughed. There is no clear data on unemployment and forbearance due to these government intervention programs. We could potentially see more extensions of unemployment programs and this mortgage payment break, but these government programs don't actually fix the problem. The question is whether or not the rising house prices is sustainable and how much longer this can continue before eventually the house prices begin to stabilize or they begin to come down. Now overall, from an investor's point of view, real estate has always proven to be a great hedge against inflation, and that could also be driving more demand than usual because the interest rates are as low as they are. Now, as the Bank of England print more money, the purchasing power of the pound reduces, and so investing in real estate can be a hedge against this inflation. And in the US, their Federal Reserve Central Bank is printing out a lot of dollars, and so people over there also have the same concern. Some people believe investing in real estate now will protect their wealth against inflation. So if you found value out of this video, which I really hope you did, then please do give us a thumbs up, and why not subscribe so you don't miss our next financial education video. I'll see you on the next one. Take care.